In this episode, we're going to cover the differences between the asset and a stock purchase. We'll talk about the pros and the cons of each for the buyer and the seller. And then we'll cover a seldom used but becoming much more popular tax election for a qualified stock purchase program. And we'll cover the qualifications. It's called a 338H10, and it combines both a stock purchase and an asset purchase. So if you're buying or selling a small business, stick around. You might find this video helpful. So let's take a look at both Brent and Bill. Brent owns Triple B Inc., which is a C corporation with 100 shares outstanding and includes operating assets. Bill owns ABC Inc., an S corp with 100 shares, and Bill is going to acquire Brent's company. Now, the first format that we're going to take a look at is an asset sale. In an asset sale, you can see that ABC Inc. is purchasing the operating assets, both tangible and intangible, from Triple B Inc. So ABC is writing a check to purchase those, sending that check to the corporation. So the corporation is selling those assets. And then those assets are moved over to, obviously, ABC Inc. So you're looking at those assets being moved over for the purchase price, and there'll be what's called an allocation of assets. We'll go over that in a second. But they're usually done at fair market value or at a negotiated price. Now, the operating assets of the company can include things like furniture, fixture, equipment, inventory, work in process, accounts receivable, and sometimes may include accounts payable that are tied to either work in process or inventory, as well as maybe leaving some cash or transferring some cash for working capital. The intangible items that are transferred usually in an asset sale are the name of the company, the website, phone number, anything that continues to help that company operate. So in an asset sale, ABC is buying the assets, both intangible and tangible, of Triple B. So when you're doing an asset purchase, one of the things both parties have to agree to is an allocation of assets. That is, allocating the purchase price to the assets that are being purchased. And so it usually looks like something like this. Inventory is transferred usually at cost. Equipment, furniture, fixture transferred at fair market value. Autos, heavy equipment, same thing. And then there's usually a non-compete, which is an intangible asset. Obviously, the seller's agreeing to not compete with the buyer. And then the difference between all of those and the purchase price, if there's any left over, is goodwill. And again, both parties have to agree to the allocation of assets. Inventory, equipment, autos, all tangible, usually fair market or cost. Non-compete is something that's negotiated between the two parties. And then the goodwill is the difference between the purchase price and the inventory, equipment, autos, and non-compete. So the advantages of an asset sale, and the biggest one is for the buyer. They receive a step up in the basis on the assets. An example, you're the seller, you originally bought a piece of equipment for $100,000. You've totally written it off, totally depreciated out, zero. The buyer is, in your allocation of assets, you agree that a value of, say, $75,000 for that piece of equipment. So now the buyer can re-depreciate that asset going forward. So the advantage is to definitely the buyer in this situation. Additionally, the buyer usually doesn't assume any of the liabilities of the company. Since you're buying the assets, not the company, you don't have any exposure to the company's past business dealings. So if there's litigation that comes up after the assets are sold, that's between the seller and the litigating party. And then finally, the seller retains their corporate entity. So if they want to do something else with that going forward, they can. So that's the advantages of an asset sale. Disadvantages of an asset sale for the seller, and especially if they're a C corporation, is they'll have a double taxation, both at a corporate level and then at a personal level. If it's an S corp that is selling, there'll be just a pass-through tax on that. Transferring of the assets may be more complicated, especially if you've got a lot of them and contracts are involved, than buying the stock. And again, transferring agreements, you may have to renegotiate agreements or contracts, and there may be change of control or restrictions in moving those assets over. And again, especially for companies that involve licenses like a trade company, a commercial HVAC company, a contractor, the licenses to operate those are usually not transferable. So in this case, the buyer would have to go out and obtain those licenses all over. And then finally, as part of an asset sale, obviously part of the operating assets that make any company work are its employees. In an asset sale, the seller at closing has to terminate all of their employees and the buyer has to rehire them. So there are disadvantages of an asset sale for both the buyer and the seller. So let's cover the pros and cons of a stock sale. Now in this example, Bill is using ABC Inc. to purchase 100 or all of the outstanding shares of Triple B Inc. The check will go directly to Brent, which Brent is the owner of those shares. So the advantage here on a stock sale is that there is no double taxation. So Brent gets all of that money, doesn't have to, he's selling his C corporation, and it's only taxed once. The other advantage is transferring or purchasing the shares is a much easier way to purchase the entirety of the company. It just everything, balance sheet, assets, operating, everything rolls because you, or in this case, Bill, now owns the entire stock of the company. The disadvantages of a stock sale is that the buyer has no step up in taxation of the assets. So if that $100,000 piece of equipment that we talked about earlier was completely depreciated out, Bill or ABC is basically, or not basically, is buying the balance sheet as is, and so there's no tax incentive for him based on that scenario. The other thing is that the buyer may be accepting, although purchase and sale agreements are pretty good at restricting some of those liabilities, the risk of the company's past history. So that's just something that the buyer needs to be aware of. And obviously for a seller, they're looking to do a stock purchase. The 338H10 for federal tax purposes is an asset purchase. But for legal purposes of documentation and moving the stock over, it's a stock purchase. So to qualify for this, the seller must be either a C corporation or an S corporation. The buyer and the seller, like I said, have to agree on this tax format. And then the buyer must be a corporation making a qualified stock purchase. Advantages of the 338 are really the buyer receiving the tax basis equal to the purchase price and can amortize the goodwill, obviously the difference between all of the assets that they purchased and the purchase price, over 15 years. In addition, this avoids the change of control issues that we talked about earlier, and quite frankly is just simpler. The disadvantages is really for the seller in that there's an extra tax burden, especially if you're a C Corp, you've got a double taxation going on. And if you're an S Corp, it's just a pass-through. But the fact that you're doing this as a asset sale in this hybrid document means that there's a higher tax and that the seller may want to negotiate somewhat of an increased purchase price to maybe help on that tax burden. So there you have it, the difference between the asset purchase, stock purchase, and the hybrid 338. I hope you found this video helpful and informational, and if you did, please consider hitting the like and subscribe button, and we'll see you on the next video.